Have you ever just wished for a trading strategy that was, systematic, mechanical, something you could repeat day in and day out? One that just cuts through all the noise and has you focus on just two key levels every single day? Well, let's dive right in because today we're breaking down a really powerful approach that does exactly that, and all it uses is the previous day's candle.
And look, this isn't just some abstract theory. The person whose work this is based on puts it right out there with this statement. It just goes to show you how incredibly effective a simple, focused strategy can be. This is all about watching what the market does at very specific, high-stakes price points and then reacting.
So let's get to the big question. What is it about the high and the low of the previous day that makes them so special? I mean, why these two specific lines on a chart? The answer, in a single word, is liquidity. And that right there is the secret engine driving this entire strategy.
Okay, so think of liquidity as fuel for the market. It's basically a giant pool of buy and sell orders just sitting there, waiting to be triggered. And wherever this fuel builds up, you can bet that big, significant price moves are likely to happen. Just understanding that is the first big step. And this is exactly why these levels are so darn predictable. Think about it. Above yesterday's high and below yesterday's low, you have two groups of people. You've got the people trying to limit their losses with stop orders, and you've got breakout traders trying to jump on a new trend. This creates this predictable battleground, this zone of action every single day.
All right, so it all boils down to this one simple observation you make right at the market open. Where is the price right now compared to yesterday's high and low? Seriously, that one question sets the stage for everything that follows. It gives us our market context.
And it really just comes down to these two scenarios. Are we inside range? That means the market is kind of undecided, it's balanced. Or are we outside range, where the market is already gapped up or down, signaling a potentially strong trend is underway? This context is our guide. It tells us exactly which trade setups we should even be looking for.
Okay, so now that we have our two contexts, let's see how this branches out into four very distinct trading scenarios. We're going to break down two setups for when we're inside the range and two for when we're outside. First up, the classic rejection. This is what we're on the lookout for when the market opens inside yesterday's range. It's a sign that the market is pretty balanced, and those edges of the range are probably going to act like walls.
So here's how it plays out. Price pushes up to the high, or it drops down to the low. It sweeps all that liquidity we talked about. But then it just runs out of steam. It fails to follow through. It gets rejected. That sharp reversal, that's our signal for a potential trade right back toward the middle of the range. But what if the price doesn't get rejected? What if it actually shows some real strength and looks like it wants to start a new trend? Well, that brings us to our second inside range scenario, the continuation, which you probably know as the break and retest. This is such a classic pattern. Price doesn't just smash through the level and keep going. No, it breaks it and then it comes back to test it from the other side. So what was once a ceiling now becomes a new floor. That successful hold is the confirmation we need to feel good about joining that new trend.
Okay, let's switch gears. What happens if the market has already gapped outside of yesterday's range before the opening bell even rings? This is where we look for a really powerful continuation play, sometimes called a gap and go. The key thing to realize here is that the breakout has kind of already happened in the pre-market. That shows some serious strength or weakness. All we're doing is waiting for a quick little retest of that previous day's level right after the open. If it holds, that trend often takes off with some real force. But hey, what if that pre-market strength was just a big fakeout? What if that trend completely fails? Well, that leads us to our final scenario, the reversal, which often results in something called a gap fill. This is a really powerful setup because it's based on a failure. The market tried to trend, but it couldn't pull it off. When it breaks back inside the previous day's range, that is a huge red flag that the initial move was wrong. And the next logical place for it to go? A lot of the time it's a move all the way back to fill that morning gap.
So, we've got our contexts and our four scenarios. But listen, just spotting a setup is only half the battle. To trade this effectively, we absolutely need a clear set of rules for how to act. This is what separates consistent trading from just, guessing.
And that's the million-dollar question, right? How do we take these ideas and turn them into a disciplined, actionable plan that we can use every single day? Let's break down the core principles for making this work. Here's the bottom line. If we open outside the range, the action is often fast and furious, right at the open, so be ready.
But if we're inside the range, the market is balanced, so be patient. And maybe most important of all, don't get married to a bias. Don't decide what you think is going to happen. Just create simple if-then plans and let the price action tell you what to do.
And this quote right here just perfectly sums up the entire philosophy. This isn't about having a crystal ball and predicting the future. It's about having a plan to react to what the market gives you at these very important levels. You observe, you see confirmation, and then you act.
Okay, we have covered a lot. We talk liquidity, context, 4 key setups, and the rules to tie it all together. So let's boil all of this down to this single most important takeaway from this entire framework.
At the end of the day, it all comes back to this one idea. Those two simple lines, yesterday's high and yesterday's low, they are your roadmap. They tell you where the opportunity zones are, they give you the market context, and they provide a beautifully simple framework for building a trading plan every single day.
And so that leaves us with this final question. This whole strategy is built on a specific mindset. It's a fundamental shift from trying to guess what's going to happen next to simply observing what is happening at critical levels and reacting with a plan. So which approach are you going to choose?